Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today for a special discussion on the investment outlook for 2018 is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA. He's joined by William Davies, Global Head of Equities, and Maya Bhandari, Portfolio Manager and member of the Asset Allocation Committee. Mark, 2017 could be characterised by the synchronised global growth we've seen, corporate profits rising, robust growth across the board, Europe doing quite well as well. Do you expect to see this continuing into 2018?
Well, all of the leading indicators would suggest that, yes, we would expect to see this continue in 2018. Growth is in almost all places, the exception being the UK, is expanding. The corporate profits, as you said, are growing nicely, beating expectations in most places. And monetary policy remains pretty supportive. Inflation remains low, little signs of inflationary pressures building anywhere. So we don't expect monetary policy to tighten too much. And as a result of that, that's a pretty benign environment for risk assets and equities in particular. So although markets are trading at near-time and all-time highs in most cases, and markets have done well, we would expect the positive momentum to continue into 2018.
What are you expecting in terms of monetary and fiscal policy around the world, and what are the likely repercussions?
We think monetary policy will tighten a bit. Clearly interest rates are going up in North America and we expect them to continue to go up, although not very much, but a bit from here. Monetary policy will tighten a bit in Europe as the ECP programme runs its course. And at the margin, fiscal policy will probably take up the slack a bit in terms of we'll get some additional spending in North America, tax reforms, and potentially a bit more spending in Europe as well. So we think that will probably balance out and lead to a continued support for growth in economies and growth in corporate profits.
And William, where are we in terms of global equity valuations right now?
Well, if we look at equity valuations around the world, they're higher now than they were at the beginning of the year because we've had a strong year for equities. But we have seen earnings, profits rise faster than expected in 2017. So if we look back over, say, the last 20 odd years or so, equities actually aren't that much more expensive than over that period of time. It feels as though they are, though, and it feels as though they are because many of the sectors in which we invest, where the earnings growth is stronger, those are the sectors where valuations are indeed higher at the moment.
So on a global basis, which regions and perhaps sectors, as you've mentioned, where are the opportunities going to be next year?
If we think of regions to start with, I mean, if we look at Asia, we continue to see strong growth within Asia. If we look at China, we continue to see economic growth, which is still at those elevated levels, and that serves as an engine for the region, as does indeed India, which is becoming of increasing importance within the region. Still in Asia, if we look at Japan, we see great improvements in corporate governance in Japan. Economic growth remains positive, which given the demographics is quite something. And valuations are cheaper within those particular markets, certainly than in the US, and generally in line or a bit cheaper than the world as a whole.
And which themes are you seeing or are you interested in for 2018? Because technology has been quite a key driver this year.
We talk about sectors, we talk about themes, and we talk about growth in a low interest rate environment. And technology's had it all in 2017 and has served as the driver of markets as we've gone through the year. As we go into 2018, it's less clear that the valuation support we saw in technology is there for 2018. So we still like a lot of those companies. We still think that there's attractive growth to come from there, but valuations are more stretched than they were at the beginning of the year. If we look in other sectors, it may well be that financials, which look relatively cheap against the market as a whole, in an environment where we believe economic growth will be positive, we think that the outlook for financials is improving as we go into 2018. And you can look back at the cycle and look at the CapEx cycle thus far. We still haven't really hit accelerating capital spending growth. That could be the surprise as we go through 2018.
And Maya, there's been lots of discussion about credit in recent months, of course. Are we towards the end of the cycle? How are we positioned in credit for 2018 and what do you expect to play out?
Well, in a world where we don't like long duration assets, particularly assets like core government bonds, credit, and in particular European high yield credit, has been a preferred duration light asset class for us to invest in across multi-asset portfolios. I mean, I think fundamentals look quite good. Profit margins are still quite healthy, as we've just heard. And really, we saw excess returns as being really good compensation for frictional default risk. So we're looking for 2 to 3.5% defaults across US high yield companies, for example, next year and the year after. In Europe, that number falls to below 2%. So we felt until recently that we were being quite well compensated for those underlying risks. A few weeks ago, in early December, we downgraded high yield credit to neutral for a few reasons, which I'll come to in a moment, really putting it on par with credit overall, with investment grade credit, and indeed with emerging market debt. So what's really changed? Well, I think firstly, valuations have certainly shifted and are quite demanding. Leverage is rising, both gross leverage and net leverage. And as you said, we are quite late cycle. EBITDA hasn't started to fall yet. We have seen some deterioration in credit quality, particularly in the US, not here in Europe, but certainly in the US. And the monetary policy cycle, again, in the US is not particularly favorable. So combining all of that, we felt it was more prudent to be neutral rather than favorably allocated to the asset class for the rest of this year and going into 2018.
So on a valuation basis, are equities more attractive than bonds right now?
Well, I think returns across asset classes have been pretty good in recent years, and particularly this year. So volatility adjusted returns or Sharpe ratios, as they're called, have been near the highs of the last 20 years in equities, at almost 4 for global equities, and that compares very favorably, certainly with government bonds, if not quite with corporate bonds, where the equivalent Sharpe or volatility adjusted return has been about 3.2. So it's not just equities that look quite fully valued. Everything, if you like, looks quite fully valued, or certainly a lot of things look quite fully valued. Nor, indeed, is a world without risk. We've got 10 years of quantitative easing giving way to quantitative tightening. We've got plenty of potential risk points from geopolitics to the Middle East. I could go on and on. But what has changed, and what has changed quite meaningfully, is the drivers of equity markets, which is why over the course of this year we've actually been increasing our equity allocations and continue to do so. And what has changed is after 5 or 6 years where equities were essentially being propelled higher by valuation, we were paying more and more for less and less. Over the last 12 months, equities are being propelled higher by earnings. Good earnings coming through, earnings expected to rise even faster than they've actually come through. And if you like, equities are rising for the right reasons to our minds, and equities offer a risk premium as a result that we aren't able to capture in other asset classes. So if we compare, for example, equities to corporate bonds, they carry similar levels of risk, if you like, in the corporate structure. Equities have not followed that grind lower we've seen for much of this year in corporate high yield bonds. In fact, they've essentially tracked sideways. So there's a risk premium on offer in equities that we aren't able to capture in other asset classes. And so, yes, we continue to invest in equity markets for the next 12 to 18 months.
Okay, just a quick word on China, because you manage a China dashboard for our Asset Allocation Committee. Where is the region right now, and what do you forecast for China in 2018?
Well, China has been trying for many, many years to rebalance its economy away from exports and investment-led growth towards consumption. And actually, I would suggest it's done so recently with quite remarkable success. Growth has slowed. It's slowed meaningfully. It slowed from the low teens to 6 and change, if that. But within that growth number is a much better quality of growth. So domestic demand is driving 2/3 or slightly more than 2/3 of that economic growth. Now, looking into 2018, we think that China is steady as she goes. We expect continued slowish economic growth, but driven by domestic demand, so a better quality of growth. I suppose something we worry about further out on the medium term is how China finds its way out of its trilemma, which it must. The trilemma is a fairly well established theory in economics, which essentially suggests that you cannot simultaneously manage your exchange rate, your domestic monetary policy, and your capital account. China, as we know, has been trying to manage all three and has struggled in recent years with managing all three, and we worry about that over the medium term. But for now, China seems to be steady as she goes.
And Mark, 2017 has been pretty quiet, really, from a volatility perspective. Some of those geopolitical threats that we were highlighting this time last year didn't really come to pass. Is it too quiet now, and what are the risks on the horizon that could disrupt that?
Well, the risks are the ongoing geopolitics. Clearly, we were worried coming into 2017 that we would get a rerun of populism in Europe and get an unfavourable outcome in the French election. We didn't get that. We've had murmurings, obviously, in Catalonia, which have the potential to rumble on and to manifest themselves in different parts of the Eurozone. Clearly, Angela Merkel is yet to form a government, and that has some risks. And then we've got the sort of nuclear escalations going on in North Korea, and that has the potential to be really quite bad, although that wouldn't be our central case. But sort of the backdrop remains very supportive monetary policy, which is dampening down volatility, and there is still a huge amount of liquidity out there. And we expect that liquidity to diminish slowly, and for that reason I would expect to see volatility rise gently, but I'm not expecting, barring a geopolitical event that is unforecastable, I wouldn't expect volatility to ramp up aggressively.
And inflation is a threat, I guess, for risk assets globally.
Yeah, absolutely. So the key risk to markets is clearly an uptick in US inflation. We've all been watching US unemployment kind of grind lower and yet not see wage pressures come through. Inflation remains very subdued, and if inflation were to start to accelerate, I think the Fed would tighten very, very aggressively because it's worried about what 10 years of quantitative easing has done to latent inflationary pressures. So that would unsettle markets. We'd see a steepening yield curve, and we'd see risk assets sell off quite aggressively, I suspect. That isn't our central case, but all eyes are on inflation to make sure that we don't miss that were that to come through.
And William, on a sort of optimistic front, what are the sort of key drivers do you think that could see your positions come good in 2018?
Well, as has been mentioned, I mean, the economic environment is the single most supportive thing for equities around the world. It's going to help drive earnings, going to help drive profitability as we go through. But that strength, that economic environment, the steady economic growth, could ultimately become the threat if growth is too strong, wages start to pick up, you see interest rates rising at the same time as margins come under pressure as wages come through. Thus far in the cycle, this has not occurred. It will occur at some stage, and as Mark says, our central case is that will not occur in 2018, but boy, do we have to keep our eyes open in order to ensure that when that does occur, we're prepared for it.
These are the so-called Goldilocks conditions of things being just right.
Thus far, Mark, that's right.
Maya, what are your thoughts on those Goldilocks conditions persisting?
We expect Goldilocks conditions to persist for the next 12 to 18 months. Our central forecasts are for steady-as-she-goes economic growth, sort of 2.2% in the US, for example, with not much by way of inflation. And we think that environment supports certain risk assets like equities, like commodities, and indeed UK commercial property. We are less positively allocated towards core government bonds, which we don't like in the current environment, and are neutral credit and cash.
Well, panel, thank you very much.